Conversations That Matter is a partner program of the Center for Dialogue at Simon Fraser University. The production of this program is made possible thanks to the support of the following and viewers like you. It's Monday, August the 24th right now. When the markets opened this morning, they took a dive. In North America, the Dow took a 1,000 point drop. It's scrambled its way back up, but it's still down about 600 points at closing. Mm-hmm. What's happening?
The market's undergoing a correction, and we haven't had a correction of any significance for a long time. Markets do go up and down. I think people have gotten used to them going in only one direction. But fundamentally, I think people are worrying about the slowdown in China. That's something we've worried about and expected for a long time. So we don't see anything really different in the way we're looking at the world. A slow, muddle-through recovery is what's been going on for the last number of years, and we're still on that track. But I think people are starting to realize that things aren't going to be as rosy in China, and that's what really started the sell-off last week when they started tinkering with their exchange rate, which had been fixed to the U.S. dollar.
For decades it had been fixed to the U.S. dollar.
It had been,
yeah.
and the U.S. dollar has been very strong. So the Chinese currency had been rising in lockstep with that U.S. dollar. And year over year, it's only down 4%. Next to the Hong Kong dollar, it's the second best performing currency relative to the United States currency over the last year. For comparison, the Canadian dollar, the euro, the yen, they're all down about 17%. The Mexican peso is down about 20%. The former shining stars of the so-called BRIC region, Brazil and Russia, have seen their currencies drop 35 and 45% respectively year over year. So people are starting to think that, hey, maybe China is going to play some catch up here, between the appreciation in their currency relative to everybody else and sort of rampant labor inflation. They've grown very uncompetitive relative to some of their trading partners. And I think people are starting to realize, hey, maybe they're running out of tools or they're going to have to resort to depreciating their currency to get their economy moving.
So what does this mean to the Canadian economy as we move forward? Because if we go back and take a look at 2008, 2009, when there was the great sort of financial crisis, we could look to our relationship with China and say, well, that shielded Canada in many ways from experiencing the lows that they did in the United States and the same in Europe. When we take a look at what's happening right now, how do you see it affecting the Canadian economy?
Well, it's good to go back to the financial crisis, and really the financial system was on the brink of collapsing globally. People had lost faith in the financial system, and had the authorities and the central bankers around the world not all moved in unison, used all the policy tools at their disposal to reflate the global economy, to reinstill confidence in the financial system, we could very well have had another depression. The good news is that everybody acted together, and they got the global economy back on its feet. And then China let us out of it. I would have thought, and a lot of people thought, that with weakness around the world, China being an exporter, the world's production house, that they would have really suffered. But the leaders there decided to add a lot of stimulus, a lot of government spending, a lot of investment spending. They really poured gas on the fire and led the global economy out of the sort of so-called Great Recession. And that was great news for Canada, because commodities and resource businesses really took it on the chin when the crisis hit, but the recovery was relatively fast and commodity prices rallied back. And so those parts of the Canadian economy weren't down for very long, and they continued to do well. But as time has progressed and China has slowed down, and a lot of the excess production in oil or copper or iron ore started to meet slowing demand, we've had a more precipitous drop in commodity prices, and that weighs on the Canadian economy.
So how does that look for resource companies in Canada right now? When you're talking to your investors, what are you telling them about the resource sector here in this country?
Well, there's a place for cyclical stocks in a portfolio, but we're telling people that it's not a time to back up the truck. You know, having 10, 15% of your portfolio exposed to those cyclical areas of the market that are very beaten up, that probably will perform well over the long term is a good idea. But in a world that we think is just going to muddle along and we're going to have slow growth, we're not going back to the good old days. And we can talk about why we're not going back to the good old days. We don't think you want to have oversized positions to cyclical businesses that really require robust growth in the world, synchronized robust growth around the world to really drive the profitability of those industries. And we don't see that on the horizon.
Are we not going back to those good old days because of what's happening to oil? Or is that only
Well, there's a
part of the
chicken and
equation?
egg.
Yeah.
It's only part of the equation. The reason we're not going back to those good old days is that the world has too much debt. It's really as simple as that. And it's like an individual that's racked up their credit card. Once they've maxed it out, you know, the good times, the party's over. You got to live within your means, and that's really where the world is. We brought a whole bunch of consumption forward. When we talk about China, they had an incredible debt-driven investment boom, but they have excess capacity across the board. They have a lot of empty homes. They have a lot of empty office towers. They've got a lot of underutilized factories, underutilized, you know, rails and airports, and you know, they've built so much, and it's going to take them years to utilize what they've built already. You know, to give you an example, you know, they've built out their highway system. They now have more miles of highway than the United States, and yet they only have about a quarter of the cars. So
Great for driving, but
great for driving, but they've already built the highways that they need for a whole bunch of years. And building stuff creates a lot of jobs. But if you're already overbuilt and you got to stop building things, then that employment disappears. And if that employment disappears, where are you going to get the jobs to drive incomes and consumption? They're trying to make the transition from an investment and export-led economy to one driven by consumption. But if all the jobs were created building stuff, and you stop building stuff like you at the pace that you were, then it's hard to fathom how they make that transition, or at least make that transition smoothly. And you know, I think what people are opening their eyes to, and they're realizing that that's going to be difficult to happen. Their only hope is to do it through exports, and there's competitive devaluations going on around the world, and there has been ever since this crisis. Everybody wants a lower currency so they can export their way to prosperity, but you know, it's a zero-sum game. Everybody can't do it. And because the Chinese have had their currency pegged to the US dollar, they've been growing uncompetitive vis-a-vis everybody else that's seen their currency depreciate. So people are starting to say, wow, maybe that's the next tool that they're going to use. And there's a lot of debate about that. I don't know whether or not it happens or not, but the fact of the matter is that the economic model that China used for decades here is running out of steam.
I got to ask you to hang on for just a second here, Murray, while we take a quick break. We'll be right back.
Conversations That Matter is a not-for-profit program made possible thanks to the charitable support of the following and from viewers like you. Please visit conversationsthatmatter.tv and help us to continue to produce this program. Thank you.
So does that cause you concern about China, or is it just that we're going to see a slowdown in their growth? It's are all of a sudden we're going to go, oh my gosh, China's in recession now, or is it just that they're not growing as fast?
I think a recession in China could mean the economy actually shrinks. You know, the official
In China, the economy could actually shrink.
It's probably not growing right now. It might even be shrinking already, you know. The official statistics say GDP is growing at 7%. But, you know, House prices are down year over year. Auto sales are down year over year. Electricity usage is flat. Rail shipments are down. So a lot of indicators are suggesting there isn't a lot of growth in the Chinese economy. On second quarter conference calls, CEOs of multinational firms all describe business conditions in China as tough. So
Which
the
is unusual
anecdotal
language,
evidence
yeah.
is very different than what the official statistics tell you. So, and the commodity markets are behaving as if the situation's more serious than the official statistics would lead you to believe. So
we're in an interesting position in Canada in the sense that China isn't our only market. Our major trading partner is just to the south of us.
yeah.
How's it looking there at the moment? And how does that affect us?
Well, I think the slowdown, as long as it's not too hard of a landing in China and has ripple effects around the world, the slowdown in China is actually good for America. They're the world's biggest consumer. 70% of their economy is consumption, consumer spending. And if the slowdown in China, creates deflationary pressure and puts downward pressure on inflation and therefore interest rates, if it puts downward pressure on oil and other commodity prices, that's good for the U.S. consumer. They'll go out and spend more. By extension, that helps Canada. So there's mixed influences on the Canadian economy. China slowing down is not good for resource prices or resource demand. That affects our resource sectors, but it's good for our neighbor to the south, which is roughly 10 times as big as Canada. So our exports to them, and they're our biggest export partner, that helps. So
if we take a look at the price of oil right at the moment, globally, it is plummeting, and it appears that the Saudis are the authors of this. They're driving it down, and it has a negative impact on the Canadian economy, the Canadian dollar. But what's it doing to the U.S. economy, watching that price of oil drop?
it's helping.
So it's,
on balance,
yeah.
It helps consumers more than it hurts their oil patch.
Well, and their oil patch can produce for much less than we can.
Well, it depends on the regions and who we're talking about, but the real low-cost production comes out of the Middle East, and the Saudis decided, we're not giving up market share to shale production in the United States, which has boomed in recent years. But a lot of that is higher cost production, and they're saying, you know what, we're gonna keep producing. We'll keep prices down for long enough, so that some of this higher cost shale production in the U.S. isn't economic and shuts down. That's the theory.
Once again, unfortunately, I got to get you to hang on for just a moment while we take a second of our 3 breaks. We'll be right back.
Conversations That Matter is a not-for-profit program made possible thanks to the charitable support of the following and from viewers like you. Please visit conversationsthatmatter.tv and help us to continue to produce this program. Thank you.
Individual investors are at the moment going, I can't keep up with the institutional investors. Where should I be paying attention? Well,
for a long time, before the financial crisis, we'd been telling people that they should be getting their money out of Canada.
You've already been telling people to get their money out of Canada. How come?
For about a decade.
Why? Aren't we a good investment?
Well, sure, but there's better, there's good companies in Canada, but there's a bigger universe of companies to choose from outside the country. And if you're looking for high quality businesses, companies with high returns on capital that are trading at a reasonable price, it's easier to find them south of the border. I run a team of analysts. There's 6 of us in total, and the guys for quite some time have been finding it easier to find the great opportunities south of the border.
But didn't we miss that opportunity with the drop in the Canadian dollar? Now that the dollar, the cost has gotten higher of getting into that market, doesn't that make it a little less attractive?
Absolutely, and that's a good point. The decision to underweight resource stocks and overweight higher quality businesses and less cyclical sectors was a lot easier decision prior to the financial crisis. If we go back to, say, 2007, we were looking ahead to a world that we thought would slow down. There was 3 factors that caused that view. The price of oil was sky high. The Federal Reserve and other central banks around the world were raising interest rates, and the U.S. housing market was already starting to roll over, and cause, so those 3 factors were going to cause the global economy to slow down, and yet at that time people loved commodities and related stocks. They were expensive and popular, and at the same time, blue chip American companies, the Johnson & Johnsons of this world, they were dirt cheap. So the dollar was at par or higher.
Yeah.
So the decision to take an overvalued dollar to buy out of favor blue chip American stocks was very easy. Fast forward to today,
Yeah.
and so the valuation and sentiment differentials have reversed. Blue chip stocks I wouldn't call too expensive, but they're on the higher side of reasonable. They've had a great run for 5 or 6 years here. And it's the cyclical stuff that's very much out of favor now and beaten up. So statistically cheap. So if one wasn't, if one was thinking about these things in a vacuum and not thinking about where we are in the economic cycle, you'd be selling these higher quality businesses and putting it into the cyclical arena. But if you start to layer in some thinking about what's going on with the economic cycle around the world, you might hesitate. China is slowing down, and everything in the world is cyclical. And if you study booms and busts around the world, the bigger the boom, ultimately the bigger the bust.
Yes.
And China, probably has had the biggest economic boom the world has ever seen. So there's probably an ugly side to it. And we may only be in the 2nd or 3rd inning of the Chinese slowdown. So if you're focused on that cycle as the cycle that drives the cyclical stuff, it might be really cheap for a good reason. So at a minimum, we think we'd need to let some time pass before we step into some of those things. Now, there's demand and supply for all these commodities. And when we're talking about China's slowdown, that's affecting the demand side of the equation. But when prices drop, they say the cure for low prices is low prices. And that's because producers, when they're faced with low prices, will cut back production.
Yeah.
It's starting to happen. So the supply side of the equation will correct, and we will have a recovery.
Final break, promise. We'll be right back after this.
Conversations That Matter is a not-for-profit program made possible thanks to the charitable support of the following and from viewers like you. Please visit conversationsthatmatter.tv and help us to continue to produce this program. Thank you.
Okay, I live, work, own, do everything in Canada. Just on a day-to-day basis, should I be concerned? Based on what you're saying, invest outside of the country. Like I hear you say,
No, I don't. No, I don't think you should be overly concerned. I don't think the global economy's going into recession. Recessions don't typically happen when monetary policy is loose and accommodative. So the low interest rate policy, it's better for the rich. It's better for the haves and the have-nots. It's driving a bigger divide between the haves and have-nots around the world. If we stay on this path, it's going to drive social unrest, and that's not going to be good for anyone. Fundamental value of good businesses. At the end of the day, we think, the route to wealth preservation and wealth growth is to own pieces of good businesses. And we've been arguing that in a slow growth world, you should favor the most profitable businesses, the ones, the best ones with competitive moats, the ones with great cash flow and the ability to invest in their people and their products and services to expand internationally in a slow growth environment. And that rationale has not changed here.
yeah. So at the end of the day, on a good day, that sounds like sound advice. Today is Monday, the 24th of August. Are you still saying the same thing?
Well, fundamentally, when I look at the world, nothing's changed. we have been saying ever since the financial crisis that because there's too much debt in the world, because too many countries or sectors or individuals brought consumption forward, that we're going to have to, as a world, live within our means. That means slower growth. Just because the Dow dropped 1,000 points at the open today, like that fundamental outlook does not change. I think part of what's happening out there is the average holding period for your typical stock, 5 or 6 decades ago, it was probably 8 years. Mm-hmm. Now it's less than a year. Investing's a long-term endeavor, but most people out there are not thinking about the long term. They don't have a long-term thesis. They're investing based on what the crowd's doing or what happened yesterday or what the Fed's going to do next week, and they're not good fundamental reasons to invest. And so when the market starts going in a different, they're confused. They start to panic. They don't know because they don't have a hat, a hook to hang their hat on with regard to a feeling about where a business is going over the long term. If you do, and you're realistic about economic expectations, then you should be looking at these air pockets in the market opportunistically. Maybe something that we really like is getting cheaper, and we should think about when we might want to buy it. But
and that ultimately is the most important message, isn't it? Have a long-term view, and understand what you're investing in and how the process works over time.
Absolutely. Like, the road to riches is not through trading. And I think too many people think, the stock market, they think of the stock market more as going to the casino and gambling, or, you got to duck in and out. And that isn't the way, the really rich people in the world got that way. They got that by owning businesses or pieces of businesses and hanging on to them for the long term. Mm-hmm. I don't see people running around thinking about selling their house today because the Dow Jones went down 1,000 points. Why should you sell your business? Right. Private business owners don't turn on the news at night and go, oh my gosh, the Dow's down 1,000 points. Let's call the private equity guys and sell my business. Just because there's a market where you can buy and sell something doesn't mean you have to use it.
Yeah, so stay calm, carry on.
That's good advice.
Thank you very much. Thanks for doing this. Yeah.